Well, welcome back, everyone. It's Elite Business Live 2026. I'm Oli Barrett, your host, as we ask ourselves the question, how do you master the perfect pitch? We've got an all-star lineup, but I'm going to start my questioning with you, our audience online, and also here in London. My question is, do you think, and we might see a QR code for this in due course, do you think funding is essential, and I don't mean customer funding, I mean probably external investment funding, or could be debt, in that sense, is essential for your business? Do you think funding is essential for your business? I'm going to thrive off your questions in this session, so do keep them coming in. Have a look at that. Let me tell you who's here. Louise Hill needs no introduction. We're going to come back to you, the founder of GoHenry, who's just given an outstanding keynote. Richard Bearman from the British Business Bank, one of our brilliant partners at Elite Business Live. Now the Chief Development Officer. So that is all about making sure that ambitious UK businesses get the right finance. That could be debt, that could be equity, so background also in the private sector, but now very much leading the charge on the development of the BBB. Welcome, Richard. Louise Doyle, great to see you, Louise, is the founder of Needi. This is completely brilliant, this company. It's all things gifting, so it could be gifting for your employees, could be your clients, it could be for events and so on. So backed by, I think, 1.4 million VC round, congratulations, but really questioning or will tell us how you scale whilst also taking on rounds of investment as well. Welcome back to EBL, Ian Merricks. He's a founder himself, but also very trusted by some of the best entrepreneurs I've ever met. He's the proposition lead at Venture Path. He is your sweet spot in connecting founders with Series A, Series B. That's my sense of it. Also the founding partner at White Horse Capital. So you've been by the side of many a good entrepreneur. Thank you, Ian. Kieran Burke is from Swoop. Love welcoming Swoop back to EBL. You're our sat-nav in the room, helping SMEs access what's out there. Could be loans, could be grants, could be equity. So you see thousands of funding applications. You're sort of in the middle of the sort of volcano there, seeing what's coming in. So help guide us. Here's a question. When you're pitching, hands up, remind me again who's done a pitch in the last month. In the last month, you've had to pitch your business. Here's a quick fire. What's the fastest way for a founder to lose the confidence of an investor within that? Why have you started negative, Oli? What's the fastest way to lose the confidence of an investor in that first 5 minutes? We'll jump around a bit. Louise?
I actually think it's quite a Goldilocks situation. I think you go into it and you're not confident enough, then why is the investor going to invest in you? But you go in and you're too confident, you come across as maybe even a bit unhinged, you're so excited about your company. Equally, they're going to think you're a high risk, so you've got to get it just right. You're confident enough in your business, you've got good enough ambition, but you're willing to learn.
I once took a group of British founders to San Francisco for the week, and our coach after the pitching session said, Oli, you need to tell these founders to stop being so British. And then just as I was about to leave the room, they said, and by the way, the British thing, we love it. I was very confused. So we'll help walk the tightrope a bit later. Ian, how do we lose the confidence?
Lack of preparedness, I think, lack of preparation. And sometimes that will come out in your confidence because you think, maybe I haven't mastered all of my numbers. But VCs are trained to focus on the numbers, and they're going to get there really quickly. So good, thorough preparation, understanding all of your customer metrics, your unit economics, the ask, the investor proposition is all really essential things. And if you don't have that, then VCs will sense that. They see lots and lots of businesses.
And how would that, Ian, just give me a sense of how that shows up really early on. I get how that crumbles under questioning, but early on, and you're thinking, I'm not sure about this. How does that show up?
So in the first 5 minutes, which is your question, it might be, we're looking to raise 4 to 7 million. Well, which is it, 4 or 7? We're looking to raise 10 million for a 10% stake. Wow, this is a 90 million pre-money valuation business. Yeah, now just those early things instantly can turn a VC off.
The red flag. Okay, Kieran.
I think 2 things for me within the first 10 minutes. If they don't explain what they do, a lot of the time they'll just come in and try to say everything in one go. And funders, whether it's grant, equity or loans, they have short attention span because they see so many applications. So if you can't articulate what you do as a business quickly, you're going to lose them. And I think piggybacking a bit on Ian, the numbers are so important, particularly on the equity side of things. You again see these long introductions and they avoid talking about any numbers whatsoever. So if you don't talk about revenue or profit in the first 5 minutes, again, they're cold-blooded investors. They're not here to like you. They want to make money. So if you don't talk about your numbers quickly, then it's going to be hard for them to stay in the room.
All right, so 5 minutes on the vision could be 5 minutes. Not 5 minutes too much. We need some of it, but we have to get to show, the show me the money bit. All right, Richard and Louise, I will come to you on this because you've smashed it and got out the other side with this successful investment too. Richard, and by the way, British Business Bank, yes, can cut its own checks now, but you're also in the business of funding the funders. So often the people pitching to you could be the funders themselves.
Yes, very true. Very true. I mean, I just build on that a little bit. I think it's that key point about you've got that sort of very short period to excite that person standing in front. So it is about making sure the opportunity comes out really loud and clear, and as you say, not diving into too much detail or too much waffle. It's what's the opportunity? Why do I need to listen more to this pitch?
Yeah. And just on that losing the confidence in the first 5 minutes, Louise Hill, what came to your mind as I asked?
The word that Richard's just used, waffle. It's very easy to, in your opening phrases, to start waffling. And I think that does immediately you lose clarity, and therefore the investor loses confidence. And the other thing I've got to say that I hope I've not done it, I've certainly seen from the other side, is pitching really hard how brilliant your business is and forgetting that what the investor wants out of it. Yep. So I think it's going back to some of the points Kieran made. Yeah.
Super helpful. And so I've got sort of individual questions, and thank you already for submitting some questions in. Ian, really stupid question. I apologise. If I'm going to meet an investor, do they actually want a pitch as I'm going face to face? Aren't I just going in for a bit of a chat, for a bit of a coffee?
I think if you're not raising yet, then having a chat and a coffee is okay. If you're absolutely raising, then having the structure that a deck gives you to help you when you're under a bit of pressure to tell the story in the best possible way, to lead with all of the key components of that story and get, to Louise's point, to the culmination of all of that, which is here's the opportunity for you, Mr., Mrs. Investor, to make money from this opportunity. Right. So that structure helps you get through the meetings more quickly, which in turn helps you qualify their interest sooner.
Right, interesting, and we'll hear about the sort of more of the sort of masterclass on how to make sure that goes well. By the way, we're on the fence here, Elite Business Live, because half of you think that funding is essential to scale your business, half of you don't think it does, and I don't know whether it's a good thing if one of those numbers go either way. But let's get into it with some things which have already come up. The minister mentioned this earlier: EIS. SEIS. Talk us back through it, Louise. You've been through this process as a founder. Why do those four-letter acronyms matter so much, if they do?
They really, really did for us anyway. I remember before we started pitching for investment, I was told you had to send over 100 pitch decks before you'd get an answer, and I strongly disagree with that now. You have to choose who you're pitching to, and again, like Louise said, know your investor and know what they want what's going to benefit them and what's in it for them too. SEIS for early stage angel investors was critical. And actually a lot of the potential angels that we went out to, I assumed they knew all about it because they're an angel, which is like a really cool, scary thing for me at the time, but they didn't. So what I just did was I included a very simple YouTube video that explained what the benefits were to them, and that unlocked so much funding so quickly.
So who's across this? Hands up if you're familiar with SEIS, Seed Enterprise Investments. Okay, only about a quarter of the audience. Just quick reminder, Louise.
It's just about the tax benefits from an investor's point of view. It really highly de-risks what they're putting into your business. So if you were to go bust, they would get a bit of money back, and they get a lot of tax rebate as well.
Yeah, and so there, can you give us a real example of how that genuinely shifted the needle to an outcome?
Sure. It literally, I think I got about 5 phone calls within a day when I actually sent it out to the angels that I'd previously contacted and said, can I talk to you about this? And they went, gosh, I didn't realise it was that beneficial. So it just opened up chats.
Brilliant, because some people might say, don't patronise me, I'm an official investor. But actually, if you get the tone right...
Yeah, exactly. And that comes back to Louise's point of making sure you're sending it to the right people. That could have really annoyed other people.
Right. Anything you wish you'd known on that, Louise, because you were pitching through your brother at the time to his city mates. I don't know how sophisticated or not they would have been, but was there a trick in how you pitched them as the private individuals?
I think, honestly, I think it was pulling on their heartstrings in the very, very early days. You know, I do look back and think about me walking around at the time with a PowerPoint printed out deck that we would hand them. And just how naive I was.
Right.
But yeah.
So let's just take a step back, right, Richard? So we're pitching here as businesses. We might be pitching for debt. We might be pitching for equity. Same, or a different ballgame?
There are a lot of similarities, but I think the big difference, and it's probably an obvious one, but I think it's really important to draw out, is the sort of the focus on the forward look or the backward look. Mm-hmm. For debt, obviously the future strategy is important, cash flow forecast, et cetera, but the decision is fundamentally built on the revenue, past revenues, cash flow, and that confidence that that is going to flow through. So the strategy bit is based on that past performance and stability. Equity is higher risk and generally more likely to be obviously pre-revenue or pre-profit. And yes, again, they will look at the past performance. They want to know about market testing, revenue if there is any, but much more interested in that growth story, much more interested in that future look. Both are important, forward and back, but the focus for debt is a bit more on the backward looking.
I wonder if there are certain founders who think, do you know, it hadn't even occurred to me to go for debt funding because I assumed nobody would say, yes, you used to work for a very big bank with another 4-letter acronym. What do you say to those founders?
I think it's really important to consider debt and equity. And actually, for funding, it's actually the right funding or investment at the right time. And I think, personally, the most successful businesses will use a blend of both.
Right, so super quick fire. Risk is not something to be avoided for entrepreneurs, but it is to be understood. So we talk about that sort of sense of, you know, the promise, the forward-looking thing, particularly for equity. How do you frame risk in a sort of sensible way?
Really important not to hide it. Yep. So in a pitch, it's important to call out the 2 or 3 risks, I think, quite early. What are the risks? It shows your commercial awareness, but then also what your mitigants, what your controls. The other thing to remember is the person that's challenging you in that first stage, if that's going to progress, they're going to become your advocate inside the organization. They will then take it to an investment committee or a credit committee. So help them to help you, because at that point, they're defending your risk position.
Right, got it. Now, Ian, you have coached many entrepreneurs through this. Let's go up to sort of, in terms of equity, to helping people pitch to venture capital, right? Now, I've seen you say before, actually, the point of that first meeting isn't actually to get a absolute immediate, yes, wouldn't that be a dream? What is actually going on in that first encounter?
Yeah, so I think this is the big difference between the step change between seed stage and Series A. So you're moving from being able to pull on the heartstrings. Mm-hmm. You know, look, I'm backable, I'm great, I'm going to work really hard, and that works with an angel audience. For a VC, they're managing other people's money. So because of that, they've got a job to do, they've made promises about what they're allowed to invest in, and that is so that initial pitch is a discovery aspect. It's not a, would you back me? I'm great, I'm going to work really hard. It's much more about saying, here's the proof points, do they align with your thesis? The thesis is the promise that the VCs have made to their underlying investors. And so the job of that first meeting isn't to get them to say yes or no, it's to get them to qualify whether you're a good fit for their fund, which you should arguably have done a bit of homework, a bit of prep.
So discovery about the business itself, not so much about the market? Discovery
about the business and the investment opportunity. If you focus purely on discovering about the business, you will leave thinking, well, they felt very interested. And they will be interested. You are engaging people, right? You've got a story to tell, you've got a business you're building. The job you're there to do is to see if they're interested in investing in your business, which is a different thing. So that's the worry about just focusing on the business, not the investment opportunity.
Right. So what's happened when we've asked lots of guests at Elite Business Live before, what are the 4 numbers that they tend to focus in on? You know, how much they're raising, what's the valuation, potential exit, what will be their return on investment, which is one of those 4, if you like, that causes problems, shall we say, in expectations?
They're interlinked. They're interlinked. So this is where, back to my first response, which is around preparation, you sort this out at home, in your office, way before you're sat in front of an investor, because the ask could instantly turn them off. If what you're raising is too big for the stage that you're at, or too small, and it's not going to get you through to profitability, then that's a problem. If the implied valuation, because you're raising 10 million, is a 90 million pre-money valuation, then have you got the revenue to support that? Could you mitigate that by breaking it down and doing it in stages, in milestones? And the exit and ROI calculation is a bit of an art, not science here, because VCs will not want you to tell them how much money they're going to make.
Okay.
But it's not a bad idea to guide them. So say other businesses like ours, similar to ours, have had these kind of exits.
That makes more sense. Really clear. Kieran, I've got some sort of non-data questions, but I do want us to remind ourselves, you help us cut through some of the fog on this to find out what's actually out there. Just remind us about Swoop.
Yeah, well, I suppose even personally speaking, raised 25 million across equity lending and grants, so have kind of taken a blended approach through our own growth journey. And then with Swoop, what we do is look at businesses' data sets and assess what blended approach in the market is available to them, whether that's looking at lending, whether that's looking at equity, or looking at grants. And to date, we've done 2 billion in funding for the 300,000 SMEs.
Amazing.
On Swoop.
What is the missing word? You say, I can't believe more funders don't go for X. What's X in terms of available resources?
Well, I think it's maybe piggybacking a bit on what Richard was saying, is just being aware of what's available to you and don't blindside yourself to any one route. So, for instance, one of the great things about the UK is it has this amazing scheme, the Startup Loan Scheme, where if you're looking to start up a business, you can get access to up to £25,000, which should be spread over 5 years at a flat rate of 6%, which is pretty amazing when the base rate is at 3.75.
Totally. And you get a mentor.
You get a mentor, but you have something that allows you to go. It could be a production run, it could be doing an MVP, and because you can spread it, it becomes achievable. It gives you that time to work out your pitch if you do want to go down that equity route. And again, taking in from Lou's side of things, using SEIS, CIS, it's a wonderful scheme because VC is so hard. It's a 0.001% game. You need a market size that is in the billions. Whereas SEIS, EIS opens up so much, like your brother or people like that. The family, friends all come into the mix.
This makes sense. But going back to your own fundraising, what Ian's getting us thinking about is something's going on in the back of an investor's mind as they're meeting. So what are they assessing that's not on the slides at all?
Yeah, so I think it depends on which one you're going down. So say let's take grants, for instance. It's all about technology readiness. So they're assessing on a scale of 0 to 9. Most of the time they're focusing on TRL 6 to 8. That's their sweet spot. So what does that mean? If you're innovating and doing something really forward-thinking, they want to see that you're advancing that technology, but you haven't quite commercialized it yet. Yep. So they're the data nuances they're trying to pick up. From a debt funder's perspective, it's all about your numbers, like what's your profitability, or if you're on your balance sheet, do you have trade debtors, do you have physical assets, do you have wider security? From an equity perspective, they're just interested in the growth levers. How do you go to market? When you get a customer, do they stay with you? Do they repeat? So it depends which one you're going for. They'll all have their nuances.
Yeah, that makes sense. I've got more questions, but so have you. So thank you for sending me these in. Louise Hill, any thoughts on this first question from David? How do you structure your pitch? Do you start with a problem, why you exist, or something else? What worked for you, Louise?
I think you start with the problem. What are we fixing? What is the ultimately, what's the pitch of the business?
And without pushing it too far, back to those seed investors, would that be a social problem?
Yeah, absolutely. Absolutely. Any type of problem, any gap in the market, any space that hasn't been explored yet, or a better way to do something that already exists.
So this could be anyone weighed in on this. Pitching comes in many forms. Is it better to do it in person? What if I do it over email or Zoom? Does it make a difference? Who wants to have a crack at that? Louise?
I think I've done it all. So basically, I began with having to do it over Zoom and did all of that. And that worked. It was a really good start. But then when you're going to develop that relationship, I don't think there's much that beats that in person. So I'd say if you can get the in person after.
Makes sense. Check on that, Ian Merricks.
Yeah, I would agree. The format from a VC, they look at so many deals, they'll quite often offer a 30-minute Teams call. which means you have to be really well rehearsed to get through that in 10 or 15 minutes of pitch so that there's still time to discuss the opportunity after.
Right. Here's a cheeky question to throw at you, Richard. You can tell me off afterwards. Someone's asking, what makes a bad pitch?
So I think for me, it's forgetting that there is a performance element to it, which is a little bit what we're hearing here. It's very easy to get into the detail, sort of working through, but actually you've got to snap the attention. Yes, that balance of confidence, overconfidence, but if that's not you, you need to work on that part of the skill set.
Because in a way, the investor's thinking, are you the sort of person who can turn strangers into friends? Can you go and persuade people to buy from you? So on that, question number 3. What are some of the best ways to improve my pitching skills? Anyone want to chuck in a think? Kieran, you're nodding.
Yeah, well, I think there's so many opportunities these days. Like you talked about raising on Crowdcube earlier on. You can attend a lot of these open pitches and observe and watch. And I think one of the ways as well is just ask for feedback. If you're putting yourself out there to meet all these investors, well, maybe use 5 minutes at the end to ask and get a reflection.
Love that.
So I think that's probably a good way.
I would ask for feedback 3 times, because everyone will say, yeah, it was great.
Yeah, that's a very good point.
Louise, any other tips?
Well, I was just going to say, I realise I pitch pretty much every day of my life. You know, if I'm in the back of an Uber, I've pitched the
Life's
guy
a
in the
pitch.
Uber and I have sold him GoHenry. I can't help myself.
No,
So it's
okay.
keep doing it.
These are helpful guidance. We're running out of time. Here's another missing word round then. Cash, capital, flows most confidently towards founders who what? That's the goal. Go on, fingers on buzzers. Louise Hill.
Yes, I'm going to go for that one. I don't want us to end on a negative, so I'm going first. Some of you can pick up the more positive things. Capital still flows to the people who are best connected. And so it is, how do we help more founders get better connected?
We're going to run out, forgive me, brilliant advice. One practical tip, I've not got a brother in the city, I need to get better connected. What do I do? Top tip, Louise.
Oh, angel networks, lots of events like this,
Yes.
talk to people.
Attend Elite Business Live, I totally agree.
But I think momentum is the thing that will attract people. So if you understand your numbers and you can see and articulate where big growth is happening, whether that's customer acquisition, revenue, improving contribution margin, and if you can actively display and talk about that momentum will definitely attract.
Love that sense of momentum. Ian.
Capital will flow more easily to founders who have got choices. So I think if you end up in a situation where you desperately need this money to stay alive, to pay the payroll, then that's kind of not a sexy proposition to any investor. So having, or at least being able to convey that you're in charge of the situation, you've got cash runway, and you've got options, including potentially competitive tension in the round, is a good way to get that.
So we are almost out, but Ian, because I've seen you through the superscalers and other things, helping entrepreneurs so many times, what's the thing most people won't dare to say on stage about raising VC, but actually needs to be said?
I think there's a misconception that VCs are the silver bullet, that they're going to give you money and access and all the introductions and all the help. They're a commodity, and you're buying money from them to grow your business. Yeah. And that is important because there's an imbalance initially. You're going in to talk to them and you think, wow, these people, they're big shiny offices with lots and lots of money, and I really could do with their money. But actually, you are the opportunity. You're the thing that they're looking for.
I love that. You're the ones they're looking for. Totally agree. Louise, capital flows to those who
can take people on their journey with them. I think some of the best founders that I've met are people that have taken their team on that journey, their first clients, and of course the investors on that entire journey.
I love that. And when we've spoken before, you're like, I want to be involved in this. Yeah. And back to my point to Louise, I want to work with you. This is, really helpful. Richard.
I think it's about, for founders that can really crisply explain the opportunity and explain the opportunity for the funder.
Yeah, and just that clarity.
Yep.
And good advice all around on this. Thank you for being so pithy. Thank you for helping us stick to time. Will you say a huge thank you to Louise, to Kieran, to Ian, to Louise, and of course to Richard. Brilliant. Thank you.